Hi, everyone. Thank you for joining us today. This is the MassRobotics event on fundraising for your robotics company. We are looking forward for a great event. We have more than 200 people sign up for this event from all over the world, so it's a little bit tricky to say good morning, good afternoon, or good evening, but I wish you are all doing great wherever you are in the world. My name is Fady Saad. I am a co-founder of MassRobotics. And today I have the pleasure to have Bilal Zuberi and Lidiya. Both are established VC investors covering the institutional investors and also corporate investors. A little bit about MassRobotics. Our mission is to really work and inspire the next generation of robotics and AI and connected devices companies and scale those companies. And today, after 5 years of kind of establishment and growing from 2015 to today, MassRobotics is the largest hub in the US for robotics commercialization. We are leading a cluster of around 350 robotics companies, and we have close to 60 resident companies in our 40,000 square feet of shared office and lab space in Boston. We built a large network of corporate partners. We have more than 40 corporate partners that are actively working with us and our startups. And we are very proud to work with many innovative and amazing founders. So the genesis of this event is we do 2 demo days every year. It's invite-only event for our partners and a closed network of investors. But we started off seeing lots of interesting stuff and lots of connection happen between the founders and the investors. But recently we noticed that some of our companies, they don't kind of put enough emphasis on how to speak to VCs and how to really strategize around their fundraising. And this was kind of the inspiration for us to put this event together and make sure that we kind of refresh some of the ideas around fundraising, how to prepare for it, and how to really excite and engage investors into your company, and how to properly and efficiently fundraise for your robotics company. So I'd like to welcome Bilal and Lidiya. Hi, everyone. How are you doing?
Good, hello. Thanks. Hi.
Good, good. I do believe that both of you are in the West Coast, right?
Yeah.
That's
nice
great.
And beautiful and sunny.
Amazing. It's getting warm here in Boston too, so no complaints on our side. But let me start off. I would like each one of you just to give a quick introduction about yourself and a quick introduction about your firm. So Lidiya, why don't you start?
Sure. Hi, thanks for having me, Fady. Great to be here today, and very much looking forward to the panel. I'm Lidiya Dervisheva. I'm part of Next 47. We're Siemens' venture capital fund. It's a $1.2 billion fund committed by Siemens to invest in the B2B space, pretty broad, from the enterprise space, also enterprise startups to industrial tech and deep tech. We usually invest from Series A to C. We lead deals. We invest across 3 geographies, which is North America, Europe, and Israel. And then we are basically an independent fund, so we don't need to coordinate with Siemens. We invest purely for financial returns. And where our value add comes in is once we invest, we connect the startups to our Catalyst team, which is a go-to-market team of 10 people, and we help them. We help the portfolio connect to the Siemens network and also the broader industrial network that our team has access to, and all with the idea for deal creation and actual pipeline for the startups. Just very briefly on my background, I'm originally from Bulgaria, so came to the US for college, did my undergrad at Yale in electrical engineering, got really interested in clean tech and kind of thought that I was going to go into, spend my whole career in clean tech. I worked in the energy space before on green buildings, ended up doing my MBA at Harvard, and in 2017 came to Silicon Valley and realized I'm much more interested in kind of the broader industrial space, so deep tech, AI, computer vision, and looking at kind of the digitization of more traditional industries. So now I spend a lot of my time on industries like logistics and supply chain, robotics, transportation, mobility, Still energy from time to time, smart buildings, any kind of prop tech or construction tech and so forth. And yeah, very much currently a partner at Next 47, and looking forward to the panel.
Amazing. Some of the companies that you were involved with, I know some of them, but please share it with the rest of the audience.
Sure. Yeah. So I was previously at another fund called G2VP that spun out of Kleiner Perkins. So currently they're a fund, mostly later stage funds from B to pre-IPO rounds. With them, I invested in Luminar, which is in the LiDAR space for AVs, which is currently SPAC'd and is over, I believe the market cap today is over $1 billion, over 8 billion. So that was
all going above $1 billion.
big success story there. Also invested in Carbon 3D, the plastics, thermoplastics 3D printing. And at Next 47, my latest deal is a IoT startup that hasn't been announced yet.
And I believe you were involved with Built and Geico Robotics, Markforged, Skydio, and others, right?
Correct. So Next 47 has a pretty broad portfolio, specifically in robotics. We're not afraid of hard tech and hardware. We've done probably 10 of our 33 deals have something to do with hardware. And that includes, as you said, like Gecko Robotics, AvidBots in the robotic cleaning space, and includes Vandobots, which is a company for retraining robots, also, and a few others. Yeah.
Amazing. Thank you very much, Lidiya. Bilal, your turn.
Great. Lidiya, being from Bulgaria, reminded me that, one of my best friends is actually from Bulgaria, Nikolai Stoyanov.
Awesome.
And, and we just recently, our last investment actually is in a Bulgarian entrepreneur by the name of Delian Asparahov. So it's Bulgaria is a small world, and I keep, I have too many Bulgarians and too many people from Venezuela in my portfolio. But so I'm a partner here at Lux Capital. I've been in venture now for 13 years, which is in dog years is way too long. I spent about 8 years here at Lux Capital, and I'll tell you more about it. Before that, I spent about 5 years at General Catalyst, and I was in Boston. And before that, I was an entrepreneur, built a company and sold that. And before that, I was at MIT, but did my PhD. Lux Capital is, multi-stage bi-coastal firm, managing about $2.5 billion or so. And if you include our SPAC, then almost starts to get close to $3 billion under management. We have about 150 or so portfolio companies, investing in what we call deep tech, which is the way we think about this is addressing very large societal problems that can lead to very large markets, very large companies, but doing so requires you to use science and engineering to find the solution. So this can be in any space, right? In some ways, we are not bound by, is it enterprise software or consumer technology, or is it hardware or biology or whatever. If you look at our portfolio dissected, you end up with about a third of the companies are doing something in life sciences or healthcare. That includes a lot of robotics. We last year sold a company, Auris Robotics, for about $6 billion or so, Johnson & Johnson. We have several other healthcare robotics companies, Vail and others. About another 40% or so is hardware software systems, and that's everything from satellite space, drones, robotics, 3D printing. I'm an investor in Desktop Metal and Vail Robotics. Both of them are in Boston. Meter is also in Boston. We have investments in Covariant. We're investors in Drone Racing Lead and Performance Drone Works and Anduril and Sail Drone. These are either aerial robotics companies or ocean-going robotics companies. And then a whole bunch around automating manufacturing of various sorts, from biology to tempo, which is sort of electronics manufacturing, to then semiconductor side, and then about 20% or so, I would say, of our portfolio is what you would consider sort of traditional software, enterprise software, and again, we have robots that take books and scan them at high speed so that you can have data. And then vice versa, you have a lot of NLP, AI infrastructure companies, and so on. One of the advantages and disadvantages of being in this space for so long is that you carry a lot of baggage on your shoulders. You need to take them forward. So I'm on many boards. I have several companies that have either gone public, and I'm on the boards of these public companies or are going public. And it's really interesting, frankly, to spend time with early stage entrepreneurs, because in some ways they come with the most refreshing ideas. And I think the conversation today is going to be really interesting to talk about, how do you think about financing, and how do you think about, fundraising is not a pain in the ass. I think it's a core responsibility of the CEO. And especially in these deep tech robotics areas, if you may have the most amazing idea in the world, but if you can't fund it, it dies.
Yeah, for sure. And I have to say that Bilal is probably one of the most active investors in social media. 50-60% of my social media feed is just coming from Bilal. Whether it's Twitter or LinkedIn, he's super active and always sharing what's in his mind and any interesting stuff that he comes across. So it has been a pleasure. It has been great to be in touch for some time. So let me kick off the discussion. And I always like to think that you need to start with the end in mind. And if you are a founder and you don't really understand how VCs think and how they basically look at the end game and how the whole VC industry works, probably you will have a hard time selling your company to the investors. So I would like that the three of us would have a discussion now on how do VC work? How do they make money, both from a corporate perspective, a corporate venture, and the traditional VC. So let's have a discussion on that. I mean, feel free to jump in. I would like this to be dynamic and interactive and collaborative.
Go ahead, Lidiya. You want to start?
Sure. I'll kick us off. So on our end, even though we are a corporate fund, we still, as I mentioned, we invest for financial returns. So what we want to see anytime we put money in a company, like VC money, as you might know already, does come with strings attached. So any VC would want to see an exit at some point, like within a time, and not just at some point, but over a pretty defined timeline of, let's say, 5 to 7 years after the investment. In some cases for deep tech, that obviously could be longer, and deep tech investors understand that, and we are aware of the fact that things that take more time and also more money to get to those milestones and to get to an exit. But anytime you take money from an investor, always keep in mind that that investor wants to see their money back, and also they want to see a return. And usually that means at least, not just returning their money that they invested, but making a profit on that investment. So we definitely want to see, at least a 3 to 5x when we put money. So over obviously the course of the time. And we do, we invest early as well. So we can do Series A, we can do later rounds too. So growth rounds, we don't have a cap on how late we can go. And also something to think about is the earlier an investor comes in, the higher return they're expecting, because they're taking a bigger risk. So that's the trade-off of going in early, taking more of a bet on the technology, the team, maybe a market that the VC is interested in, and then seeing down the road that money come back.
Amazing. Bilal.
So maybe just backing off a little bit to give you what might appear like a one-on-one, right? But here's how venture capital came into existence. Started off as individuals before it got institutionalized, which is that you have smart people working on really interesting ideas, but these are still highly speculative ventures, meaning you are, there's no product yet, there's no sales yet, but they're building something, maybe in their garage, right? You cannot go to a bank and take a loan, right? In a typical business, if you had a running business and you have a restaurant that's been operating for 10 years, you need to redo it, you could go get a small business loan or something like the other. And that's not available to a lot of these types of companies. I have this great idea and I want to build this little widget and it's going to do interesting things. So venture capital came into existence to say, I'll give you some capital to go build this business. I think this is an interesting idea because it can scale very rapidly. And my returns here are going to be higher if they work, meaning there's a risk that I may lose all my money, but if they work, they're going to be higher than me, buying a plot of land somewhere, right? And that started to become institutionalized when some of the early investments made in these types of ideas started to take off, and they did well. And we hear about the Intels of the world, and we hear about the HPs of the world, and Apples and Googles and so on. The way venture capital works today is that all major foundations, nonprofits, your university endowments, they take a certain portion of their endowment. So, maybe at most 15-20%, and they invest that in what they call private equity. And private equity, a big chunk of it goes to what you and I consider private equity, which is late stage, still later stage, but still, risky investments. A very small portion goes into venture capital, which is really considered high beta investments, high risk, high return, no idea if this will work or not, but aggregated, if you spread that risk over 10, 20, 30, 40 company portfolio, then, and you have a good manager that picks well and can help build these companies, you can get good returns. If you're a venture capital firm and you want to stay in business for the long term, you have to return 3 to 5x your fund. Okay. So if I'm investing out of let's take a number, $500 million fund, right? A $500 million fund has to return to its investors $2 billion plus to be a top fund, to be a top 10% fund or whatever, right? Now, think about it. In a single $500 million fund typically would invest in, let's say, 25 companies, because you want to invest 20, 30, $40 million per company over the life of a company. That's 25 companies, right? I have usually not more than 20% ownership in any of these companies, right? So you can do the math very quickly that for a $500 million fund, if your company was worth one day $1 billion, I only get $200 million, right? 200 multiplied by whatever, 20 companies is what? $4 billion. If all companies worked, I maybe end up with a 6, 7, 8x fund, right? But half the companies are probably going to die. It's just not going to work out. I'm going to lose my money. Probably another sum that I may get my money back or some portion of it back. So the few companies, let's say 5 companies per fund, if they become big returners, like massive companies, which is really hard to do, by the way, right? Most people will talk about Kleiner Perkins Google fund had only Google and everything else was kind of not very good, right? So you look for these really big exits. And what you will see in venture capital, and I think this is important to the conversation here, is that if you're talking to a venture fund, which is $500 million plus, right? You better have a business that you can say this company could be worth $5 billion, $10 billion. This is going to be the next SpaceX, Palantir, Tesla, at least a Nest, at least an Oculus. Other than the lower end Nest and Oculus, right? Like that, it's got to be big. So when you take money from a $500 million fund or bigger fund, you're certainly putting yourself in the position of, you have to go big or go home. Now, take that on the other extreme, that if you're taking money from like a $20 million fund, your company sells for $100 million. I put in a few $1 million into the company. I own 20% of the company. I get $20 million. I've already returned all my money, right? That you can do the math very quickly and see that the $20 million fund would love to also be in a $20 billion company. But even if you sell for $100, $200 million, they start to look good. So I think when you're talking to venture capital, it is really important to understand the size of the fund, the strategy that you have. Like, I think you heard Lidiya say, like we're looking for at least 3 to 5x returns. Obviously, they're also looking for higher returns. I can tell you that Lux wouldn't get off the bed in the morning if we could not clearly see that there's at least a 10x return. Like, when we're looking at, this is, I mean, if I say I can model this to a 10x return, my partners are like, yeah, whatever. I mean, it's got to be big or it just doesn't work. Which is why I think you see, investors, companies that start to do well. Instead of selling these companies, people double down. Hey, this is working. Now that it's working, let's go. Because if it's $1 billion company, maybe it can be a $10 billion company. Maybe it can be a $50 billion company. Yeah. Maybe it'll be the Tesla and be like $500 billion company. Who knows? But I think that's what drives venture capital. The scale is very, very large. People do not invest in venture capital to build a nice business to sell to somebody. That's not venture capital. In my opinion, that's not. That's like seed capital, angel capital.
Yeah, I remember at the MIT, I was kind of spending a lot of time in the entrepreneurship center and entrepreneurship groups. And I remember one time Bill Olet, the manager of the trust center, he said something that is very simple, but I do believe is very true. He said venture capital money is like rocket fuel. If you put rocket fuel in a car, it will just destroy the car. So you want to make sure that you are building a rocket before you go out and start asking for venture capital money. As Bilal said, you might be at the stage where you just need seed funding, angel funding. You are not at that point yet. And I think this is sometimes part of the frustration that I have been hearing from many of entrepreneurs and startups in this space, that, oh, we went and we spoke with the VCs, but they don't like it. They are not ready. And yes, sometimes they wouldn't be ready and you wouldn't be ready. So I think it's very important to have this manage expectation. And I do like what Lidiya and Bilal shared, that this is how the VC kind of industry works. They have obligation to their own investors, their own limited partners, and they need to return money. If they don't see in your company the potential to return money, depending on obviously the size of the fund, the stage they are investing in, and all of that, the risk profile they are taking, it will be a tough call for them. It doesn't mean that what you are building is not interesting or is not innovative. It just might mean that there is a misalignment in terms of time.
Yeah,
and it also, sorry, I was going to say that it's unclear. There's no science to when a company is ready for venture capital.
Sure.
Like, I see a lot of entrepreneurs get really frustrated that I have a working product. I actually have $1 million in revenue, but I can't raise $5 million in venture capital. And this other person that has nothing but a PowerPoint is able to raise $50 million in venture capital.
Yeah.
Right? And I think it has to do with, again, venture capitalists that you're dealing with, their ability to see, where can this go? If Elon Musk came to venture capitalists and said, I'm starting my next thing and it's going to be this next space company or something, he doesn't need to show revenues to raise capital. But if you're an MIT grad who's just starting their first company, building a robot for cleaning, pipes from the inside, I think you might need to show more.
Yeah.
Two points I wanted to make here. One is the difference. You have traditional venture capital firms, and then like Lux being a great example. But then you also have even more corporate funds than us, and we're somewhere in the obviously middle of the spectrum. But you have the very corporate funds, the CVCs of the world, that are very strategic, and those are different kinds of money. And in the way, if you're going to go with the CVCs, those are sometimes a bit more difficult money to get. So some of them might require a pilot, engagement with a corporate. Usually the timelines are a bit longer. You need to get sign off from a lot of people on the corporate side. Sometimes even the head of the business or the CEO or CTO, whoever is managing kind of the venture investment of that CVC. So just to think about, there's definitely differences of the type of capital on the venture side, and all of this is dilutive capital that will take equity. And the second point I wanted to make, that that's VC is not the only way to fund your business, right? And something from that I remember from one of my professors at HBS is like, VC is actually almost not your enemy, but they're your frenemy in a way, because they expect something from the startup. And there's VC is maybe not the first capital you ever look, and the first one is actually your customers, right? So that's purely non-dilutive, like you get money from them and you deliver your product, and that's you don't need to give up any of your equity. In fact, it's impacts your bottom line in the best way possible. The second best is the other types of non-dilutive capital. So those are grants that you can get, especially in deep tech. I mean, currently there's so many grants. There's DOE, like DOD, all Air Force, like there's so many grants, and obviously those applications take time and they're challenging, but that's basically free money, right? You don't give up equity, you deliver on the grant, on the milestones of the grant. And then once you go through that, like once you can finance your business with non-dilutive capital, then you can consider different types of dilutive capital. And there's also the hybrid dilutive/non-dilutive, which is like convertible debt, which you can get from banks. And you can get that, sometimes you can get those once you have a more developed business, you have sales, you can get, once you have, you need to buy a lot of CapEx, then you can get these revolver loans from banks. Like there's different stages of your company, you will need different types of capital.
I agree with you. I do believe that there are lots of sources of funding. One remark though is every source of funding has its own pros and cons. And as a founder, I do think that you want to do your own due diligence to fully understand what every source of funding comes with, what are the baggage. I spent some time in kind of government funding, SBRs, BAs, and getting involved with government agencies, and it's an amazing funding system. But obviously, it comes with certain baggage. It kind of impact the pacing, the speed that the company can work with. And obviously, we know that the federal government is doing amazing work in order to kind of enhance the speed and be more startup friendly and quicker to get engaged with the companies. The customer financed kind of work that you mentioned is obviously very attractive, but many times it's hard to kind of secure, especially if you want to scale and work on non-customer related kind of development. Bilal, what do you think? What's your take on other sources of funding?
So, look, there's never been a better time to start a company because there's never been more sources of financing available than available today. I mean, for startups, just to think about it, 2 years ago, no VC really had ever heard of this thing called SPACs, right? And now there's like billions and billions of dollars available in SPACs for companies. So the important thing for people who are listening to this, they should understand is that if you're going to do a startup, most people, and I was now 20 years ago or something, I was at MIT and I was like, I'm going to do a startup. And, you think about, can I build a product? And then you either feel like I can also sell it, or you go partner up with like somebody from the business school and you say, hey, become my co-founder because you'll help me sell this. That's not enough, right? You've got to, within that team, amongst yourself, however, you need to be sophisticated about fundraising. This is a key part of your job. And if you're not good at it, not everybody is or has to be, you have to find somebody who's good at it. Just like if you're not a product person, if you're an HBS grad whose undergrad degree was in English literature, you're not going to sit there and do quantum computing on your free time, right? But you may think that this is the next future and I want to build a quantum cryptography startup. Well, you're going to go find technical co-founder to help build and learn about it and figure out how to do this, right? Sure. But the same way, if you're a deeply technical founder who's never taken any course or any interaction with the business world, but you have an amazing idea that you maybe worked on for 5 years of your PhD, well, you need to get some business advice and some founder who can help you figure out what is the product, how to sell it, price it, and all that. The same way fundraising is critical. You have to have the sophistication to understand all the pros and cons like you were talking about. You also have to understand staging, right? I'm going to raise this, then I'm going to raise this, then I'm going to raise that. You have to understand the value of narrative in all of this. A lot of startup work is storytelling. Of course, you build products and you sell, but a lot of people think that startups win because they have the best technology. Sometimes that's true, but majority of the time startups work because they can move really fast. How do you build that speed and acceleration, right? You used the analogy earlier of rocket ship. I think that's an absolutely amazing analogy. We talk about a lot that, we say to people, hey, if you're being offered a ride on a rocket ship, Facebook is taking off, Snapchat is taking off, Tinder is taking off, or Clubhouse is taking off, or whatever the newest thing is, right? Tesla or the newest thing in satellite or space, just jump on it. It's a rocket. It's going to go amazing places, right? It's not a car. It's not, certainly not a bicycle, right? And you don't even ask what seat. You don't ask, I'm only going to jump on if you call me the VP engineering. No, man, just jump on it. You're going to be, if you're just an individual contributor, you're going to do really well. Well, rocket ships have something very interesting. Rocket ships have the highest acceleration when they're closest to Earth. And they need that acceleration and they need that rocket fuel, like you said, because they need to escape the Earth's gravitational field, right? Yep. They need to find this, escape velocity. And if they don't, they'll never make it to space, right? So if you're building a company that is, needs to compete, you think you're building the next space Salesforce, or you think you're building the next, Nest, or you're building the next Tesla, you can't, if you want to go to Mars, you don't start by saying, I'm going to start building a bicycle, right? It all comes down to ambitions. It all comes down to what do you want to build. There are amazing people who want to build the world's most amazing bicycle. And I'm sure they will make a lot of money doing that. But is that what you want to do? If that's what you want to do, great. Do it and use the fuel that bicycle needs, right? But if you're saying, I want to go to Mars and humanity needs to be interplanetary and whatever, then you cannot say, I will build a bicycle, then I'll build a car, then I'll build a truck, maybe then I'll build some. No. You gotta start building a rocket. And this is where I think understanding the right financing, how much money it will take, who will this money come from, in what increments it needs to come from, becomes really important.
Amazing. I want to remind everyone that feel free to start sending your questions. There's a questions tab and there's a chat tab. So please send all your questions to the questions tab. And by the way, this session is recorded and we have a YouTube channel, so all the videos are there. So if you missed something, don't worry. Lidiya, I want to kind of building on what Bilal shared, which is quite interesting. I want to share with the audience, if I'm starting a company and I want to start strategizing for fundraising, how does the process look like? What do I need to think about, and how can I kind of prepare myself to go and start speaking and getting engaged with investors?
Sure. Yeah, so thanks for the question, Fady. Basically, I would first start thinking of where you're at today, kind of where you're at with your customers, where you're at with your technology maturity, and also what's the path, the short-term path, like in the next 12 months, like are you getting to some major milestone, whether it's, let's say, certification or proving that the technology works at a certain, what's the threshold at which your technology starts creating an ROI for the customer, for example, or at which, you can get to critical velocity, that critical speed, which then will allow you to scale. So first, evaluating, like really evaluating what's your, first it starts with product, like is your product ready for prime time? And then obviously, where you're at with customer engagements, like are you still in the POC stage where you've had a bunch of conversations and you kind of have an idea of what the customer wants, but like getting to that understanding of what is it that you're really solving, and that's what investors want to see. Like I always ask this, the founders I talk to, like what is it that you're really doing? Like what is the real pain point, and also why are you solving it now? So that's a critical question. Every time I evaluate a company, it might be an amazing technology, but if I can't answer, or if the founder can't really tell me like why is now the right time to solve this and why has no one done this before, it would be hard for us to get conviction. So if you can, look at all these, and obviously having the right team to get there. So a lot of times I see companies raising, for example, a Series A, but they're, they have none of their kind of management team yet hired. It's a few like junior engineers, for example, working on a problem. I've seen great companies that have that, but it's just a harder, way to get conviction if you don't see the team that will, take the company to the next phase of their growth. So in that sense, it's more of a, a tiered approach of what are the different risks of your companies and which risks have you already mitigated? Like, have you mitigated technical risk fully, or you're still, the investor is still taking some technical risk? There's the team risk. Have you hired your key people, or you're still looking for your key hires? There's the market risk. Is your market ready? Are there any, regulations that might change the path of your technology? Are there, any changes in the market, any acquisitions that have happened, or technologies that are enabling your tech to be cheaper, faster, like for example the migration to the cloud or AI becoming more ubiquitous. There's a lot of enablers currently that allow, and also hardware, robotics hardware, for example, being cheaper and cheaper, arms, robotic arms being very ubiquitous and low cost, much lower than, let's say, 5 years ago. So taking advantage of all these enabling technologies, and then also creating the narrative of why is this a good investment today, and not in a year, not in 2 years, and not last year.
Yeah, I remember in our last call, the three of us, Bilal mentioned something that I really liked. He said that when you are getting engaged with investors and fundraising, you want to de-risk what you have. So it's all about giving data points for the investor that you did your part in terms of de-risking the investment, because it's already too risky. So at least me as an investor, I want some level of confidence that in terms of the team, you took care of that. In terms of the product, you looked at that. In terms of the market pull, you already spoke with customers, and there is a very clear market demand for what you're trying to do. It's not a technology looking for a market or a solution, and so forth. Bilal, do you want to elaborate on this? You will explain much better than me.
No. I look, the question you asked, there's layers of onion, okay? At the core of it, I would say there's three things that really matter. And in some ways, Y Combinator asked that question. What is the problem that you're solving? And is that a big enough, interesting enough problem? Yeah. Like, does it matter? Startups are hard. You might as well be building something that's useful. That's going to be very large. The second is, why are you the right team to be doing it? Like as I said, if you were like an English literature major, why are you doing a quantum cryptography startup? Yeah. Right? I mean, are you the right team? Maybe you are, but you should explain why this is the right team to be doing it. And third is, why is now the right time to be doing it? Like, why is it suddenly that there's so many LiDAR companies and so many electric vehicle and autonomous car companies and so many satellite and space companies? Like, what happened? Clearly something happened in the last 5-10 years that suddenly everybody woke up and be like, I want to be a LiDAR company. So you should think about, what is happening. Like, I'm sure if we look out a few years out, there'll be some things that will be, we will all be like, oh yeah, I'm glad that there's so many brain reading companies, right? Because it makes all the sense. There are 10 brain computer interface companies. Today, it's not so obvious, but those who can figure that out today might look like geniuses later. The thing I'd say, about the risk that you said, so when we write our investment memos internally, right, we talk about all of these things, talk about the team and how amazing it is. And sometimes that's like the most interesting thing. This is Elon Musk, right? Or Mark Zuckerberg or whoever. And that's the most important thing. We talk about the problem that, oh my God, solving cancer. Nobody will say this is a big problem. These guys have the right technology that attacks cancer in this unique way, and they have some results that show that it works. The third thing you talk about is, hey, it can be done using venture capital, meaning it's not something that requires building a $2 billion nuclear power plant to get your first data out. Right? It can be done with venture capital money. The fourth thing you talk about is a competitive landscape and the comps. Right? You say, hey, is there like 100 people doing this? If yes, then it might become commoditized, or it might be really capital intensive. Like if you started a, food delivery company when there was DoorDash and all of these companies, you'd be like, oh my God, I need to raise a lot of money just to compete with them, because they will just sell it at 0% margin forever. Right? And large companies, incumbents, try to do that. They give out your product for free to get you out of business. And the last bit you look at is, comps. Like you can build a $200 million revenue business doing consulting, and it's probably worth $200 million, right? Whereas if you build a $200 million SaaS subscription revenue business, you could be worth, $10 billion. So you have to think through that. The next thing we write in our memos is, what are the risks associated with the business? And I think it's really important to understand risks. You may have met your co-founder just like 2 months ago. Oh, we met at a MassRobotics event and we really got along. We had a lot of beer that night and we decided we're going to do this startup together. Okay, and that may be amazing, two amazing people, but you know what? A month later, they're both like, well, I think I should be the CEO. Oh no, I should be the CEO, or some other nonsense, right? Yeah. It's a team risk. It looked good on paper, but they really don't get along. right? There's a risk. Or if you have some person, if you build an entire thesis around a company built around Elon Musk, but then he gets hit by a truck. Now what do you have? You have nothing else, and Elon Musk is gone. So risk is important to evaluate and then figure out how do you reduce risk. So Elon Musk will have other executives that he will hire that, hey, in case I go crazy or I get hit by a bus, there are other people. Same thing on all other kinds of risks. Our risk is that this product will be too expensive to make. A lot of drone companies ran into that problem. Amazing ideas, amazing technology, but DJI was always half the price that they would sell it at. And DJI would still make money and these guys would not. So there's a big problem that the pricing is a big problem. It could be marketing is a risk. Oh, I have a product that every consumer should have on their wrist. Well, you know what? Consumer marketing is bloody expensive. And if Facebook ad prices go up, or if Facebook decides to cancel commercial pages or whatever, you're screwed. A customer acquisition channel completely got shut down on you. Then you have security risks, or it could be any number of risks, right? Like, if you're Verkada, you're worried about security. If you're, somebody else, you might be worried about, literally enemies looking into your systems and stealing information because you keep credit card information or something. These are all risks. Good businesses think, and good CEOs are paranoid. They're paranoid about competition. They're paranoid about their team. They have to be, in my opinion, so that the investors can sleep safely. If I see an entrepreneur that's like very chill, everything is going great, I get paranoid. I'm like, yeah, that's not how startups work.
No, this is great. This is great. We are getting lots of questions on the chat, which is good. But let me ask a quick question before we shift gears to the audience questions. Have you seen anything change since COVID? I mean, last year was obviously a crazy year, and lots of things changed. Do you see any kind of unique things, whether in terms of market dynamics, in terms of fundraising, the kind of startups that we see, fundraising over Zoom, any kind of interesting, unique things that you would like to share with us?
And we can talk about just that for an hour.
I'll share a few.
5 minutes.
I'll be brief. So a few things. Let's start with the fundraising side. Something interesting that I've been seeing is that now, because you can jump on a Zoom call, fundraising is much more democratized, right? You can get access to investors all around the world, get in front of them at any time, right? Like it's we work across time zones, across geographies now. It's much more easier with digital technology. And also, as we mentioned earlier, there's a lot of capital available. So now that capital is a bit more dynamically allocated because we have the ability to much easier reach out to people all around the world. So that's one thing. Rounds are, the market currently, it's a great fundraising market. It's a founder-friendly market. Valuations are higher. Rounds are getting done really quickly. So it's all in your favor as a founder. Nice. On the other side, for robotics, and that's where, or just in general, for anything to do with hardware, it's been a tough year, I would say. The last 12 months, we've seen a lot of supply chain challenges. There's been, shortages in ICs. There's a lot of, changes happening in China. Factories shutting down, but then reopening, and those are ripple effects that maybe can be felt months later. And especially if you have parts that were single source, and now all of a sudden you have that one part without your product is not ready for market, you can't ship because you're missing like an OLED screen or an IC. That can be like a huge challenge and create stockouts, which then reverberates in your business for months. So those are all a lot of and then the other thing is selling hardware usually until now had to be done in person. What we've seen a lot is remote demos. We've seen companies focusing just on their drivable distance customers, and where they can show up with a mask and maybe present their technology. Obviously, international expansion now is much more challenging, if not almost impossible, because we can't really travel that much to other countries. And I've still seen, like, despite all these challenges, I still see, robotics companies selling, and that's very hopeful. And I'm glad to hear that startups have been able to adapt. And kind of the takeaway of this is the ones which adapt are the ones that survive.
Sure. I mean, just in the last few weeks, we have been getting lots of great news for startup companies, whether it's Locus or Berkshire Grey or Skydio and others. So there is definitely a very positive dynamics, but I think those who managed to kind of survive last year and come up with creative and innovative ways to overcome the limitation are the one that obviously will thrive. Bilal, do you want to add anything in a couple of minutes?
Yeah, I'll just say, quickly that it's a tale of two cities. It's the haves and the have-nots. Those that have a lot, and those that don't have anything. We've gone, what, 5-6 years ago, the word unicorn became a part of our conversation, right? The billion-dollar business, and then it became a decacorn, $10 billion business, and now it's a $100 billion business, right? That's what people are chasing. So I think I feel for entrepreneurs that are not showmen, right? Or showwomen, I don't know if that's a word, but where we're not like, oh yeah, I this PowerPoint and I'm gonna be the next, $80 billion business. I'm gonna compete with SpaceX, and I have satellites that go further, and I have rockets that go faster. And many people don't have that personality, especially
Sure.
technical founders in deep tech startups. Robotics are not exactly the showman, right? And they have a harder time because VCs are getting used to these people coming in and being like, I'm going from 5 to 15 to 100 to 500 million in revenues, and then they get 100 200x ARR and multiples, and here's a robotics guy with 5 million in revenue looking for 25-3, right? And so I feel for that. That said, you can't change the externalities. You have one of two things that you can do, and this is what I tell all my portfolio companies. Your job can be one of two things. Either you try to become a showman because narration really matters, narrative matters. I mean, look at all the SPAC companies, right? These are narrative stocks mostly. Like in 2024, 2025, we're going to be doing 500 million in revenues. Today we do like 5. Okay. So either you become that, and I think that does not mean bullshitting, that does not mean lying, that does not, it just means that you have to be able to see past your immediate day-to-day, quarter-to-quarter, whatever you're dealing with, and see past that and be able to tell a story of what you want to become and how you're going to become that. And if you're not going to do that, then the job that you have as a founder and as a CEO is not to convince an investor. It's your job to find the investor who will believe in you, right? Like there's a lot of founders who waste a lot of their time and energy trying to convince people that you don't see it, but let me convince you that you will see it. That never works. So I often see that a lot with me, where founders are like, you keep sending the, I'm not interested. Sorry, I'd love to help, but let me get on this phone one more time. But did I tell you about this other customer I have?
It's
Like
very hard to change a VC mind, right?
you're wasting your
Yeah.
time. Move on to, you try
Someone
to
that,
find an investor who already has a prepared mind to invest in your company.
sure, sure. No, this is great. So, so here is what I would like to do. We got a bunch of questions. So, in order to be able to answer all of them, I would like to do this in a lighting kind of fashion. So, I'll ask the question, and then either one of you feel free to jump in. But I would like to spend no more than probably 2 minutes per question, and then I will just kind of move to the next one. So let me start with the first one. The first one is saying, what are the deal terms and conditions that one would like to watch out for and steer clear from? Any examples? So more of like terms in the kind of term sheet that may be a little bit tricky, toxic, that you want to watch.
You want to take that, Lidiya?
Sure. I mean, just a few quick things like, whether the liquidation preference, 1x liquidation preference is pretty standard today. Anything above 1x is just a little bit not so founder friendly. So watch out for any, are you giving out a board seat? Is it just an observer seat? Like sometimes, even angels want information rights, which is not too weird, but just to make sure you're aware of like who has shares in the business, what the preference of these shares are, what the exit conditions are. So there's a lot of things to watch out for. I would say today most term sheets, because the market is very founder friendly, like usually you will see mostly terms that are better for you as a founder. So it's not, yeah, not like a tons of red flags, at least that I see today.
Very good. Bilal, anything to add?
No, I think that's good. Just remember that as famous investor once told me, or as actually other people have quoted it as well, your price, my terms, I always win.
Nice, I like that. Next question is, what do people think of the non-dilutive revenue share market? I think they mean kind of using revenue share as a source of kind of funding or capital.
Mm-hmm. Well, if you use revenue share, like you commit as you create your rocket ship, you will, if you do a rev share on a small base of revenue, it's a tiny amount, but once you're a big business and that revenue actually starts mattering, it becomes a really kind of a big deal, and you might be leaving a lot on the table of having such an agreement. I've seen sometimes, for example, universities demanding a rev share if they give out, if you spin out IP from somewhere. You would rather better not to have that, but obviously that's a discussion you have with the licensing office of the university. So, the more you can protect your business from early on, and also make sure that the earlier you sign terms, like those terms, like just continue with your business as you grow. So be very careful on like what you sign in the early days. It might not look like a big deal at the time. You're just getting started. You're giving out a lot of preferential, sweet deals to your early backers, but just make sure that these are agreements that stay for years.
Amazing, amazing. Next question is, finding the right team is hard. Any advice on it? Forming the team and what people to kind of ask to join my team. Bilal, do you want to take that?
Yeah, I'll take that. Look, a lot of people ask this question about founders. I think founders are people that the way you should be thinking about this is this company would not exist if this founder was not here. Don't throw around founder titles to people just because they were early, or the second person doesn't just automatically become a co-founder, right? Think, will I not do this company if this person was not with me? If that's the case, then that's your co-founder. But the most important thing about co-founder is to understand that once you shake hands, your founder role becomes the most important role. It is not the CEO role, the CPO role, the chief technology officer, or whatever. It is the founder role, because it is entirely likely that as this company grows, neither of you will have a chief executive title, right? You have to always remember the founder role of this company is the most precious thing in the world. Like, that's how you have to think in a startup. I mean, in my company, I had many titles along the way, but the most important role I had was the co-founder title. So that's really important. And do you see eye to eye on that? Okay. So that's one. The second thing you have to keep in mind is, as you're bringing team on in the early days, the first 10 people you hire roughly, or it really sets the culture. If you don't have a very high bar, and if you can't really attract high class people, then how are you going to attract great customers, great investors, and so on? So it really sets the culture. It pushes you. There's this joke almost in the VC community, right? A players hire A+ players, and B players hire C players. It's really true, and I think VCs look for that in diligence. Like, I often look, are they attracting interesting people? Some VCs actually have sophisticated software, whether it's LinkedIn or other home-built software, to track who's joining these companies. How many people have joined, where have they come from? So I think that's really important. And then the last thing I'd say about your team is a common sense of mission, right? Deep tech companies, robotics companies, they tend to be mission-driven companies. There's something you wanted to do and solve. I think I don't think iRobot founders, it's one of the earlier companies in this space, they didn't wake up to say, let's start a company to build a dust buster for the rest of our life, right?
Yeah.
That's not what they have spent all their life basically making a vacuum cleaner, right? But that's a different issue. They did not want to build a company just to build vacuum cleaners. They thought robotics can change people's lives in their homes, in their lives, everywhere, right? That sense of mission is really important. And if you look at the three founders, some have done many companies, some have done one, some have been successful in new ones, some have been not so successful in it. Regardless, you can see that they are still mission driven. That is the mission that still goes with the life. Find teams that are mission driven, attract people, and get them to really believe in your mission that you're after.
Yeah, I would like to just add one thing here, that whenever I think of teams, find people that you have some history with, people that you went through tough times together, and see how they kind of react, especially on the founding team. I think this is very important when you are building the kind of the core team. Next question. Given the comment about the rocket fuel and needing massive acceleration early on, how do VCs view robotic startups that spend a few years bootstrapping to demonstrate customer traction before seeking VC funding to truly accelerate? Lidiya, do you want to take that?
Yeah, I mean, if you can, not everyone can bootstrap, right? It's a matter of what are your savings? Like what do you have access to? Do you have a bunch of, friends who can support your business on a, friends and family basis? Or maybe you exited a previous startup and you have a bunch of money in the bank. Like bootstrapping is not accessible to everyone. So if you can, that's fine, and it's you're getting to the next proof point, so you're de-risking the company on your own terms, and obviously that might take a bit longer. If you can do it, sure. There's always be careful of like when is the right time to add that rocket fuel, and it's okay to wait. Yeah.
Nice. Next one is saying, how do we create projections for robots that do not exist? So if you are creating your own category, a whole category, how can you build your financial model and kind of forecast and projection? It's an interesting question. Bilal, you want to comment?
Well, I think if you're raising very early financing, then all your projections are nonsensical. I don't look at any of those projections. They don't mean anything. It's like the classical, 5-year, $100 million projection, no matter what your startup. This is useless. I think the important thing people look for is, these days especially, that when people say that my TAM is very large, it has to be so large in so many billions and billions and billions of dollars that you don't even have to talk about it, right? Like none of us really talk about how big the TAM for cancer cure is, right? I mean, we know millions and millions of people have cancer. Each one of those patients spends hundreds of thousands of dollars. I mean, God only knows how many billions, right? The same thing for DoorDash. I mean, if everything in my life was delivered to me, it'd be billions, if not trillions of dollars of TAM. That's what people look for. I think a lot of people make the mistake in early stages to do all this calculation and say, my TAM is $7.3 billion. And you're like, what the hell are you talking about? Like, you have no idea. Don't talk like that. Talk about, here's the big thing that I'm trying to do. That's the reason why I'm creating this startup. That's what motivates me. That's what my team has joined me to do. That's why I quit my job and my wife freaking wants to kick me out of the house because I work 20 hours a day. That's why I'm doing this. This is my entry point into that. And this is why this is an interesting entry point, because number one, it leads me to building the bigger dream. But secondly, it is something where I don't have a lot of competition, doesn't require a lot of capital. It proves out to my customers that I can deliver a product to you. And it allows me to build systems that will then scale for the bigger thing. That I think is a critical thing.
I wanted to just quickly add to Bilal's point. Something else I look for, and I totally agree that on the early stage, like it doesn't make sense to have a detailed financial model. I look for unit economics. So I want to see that what you're building on a single scale, on a single unit, whatever that unit is, makes sense, or at least you have a path for that to make sense. Obviously hardware with scale, hardware will get cheaper. You start get better sourcing, different suppliers, you redesign, you optimize your design and so forth. But I want to see what are your unit economics today, and what is the path to decreasing them over time, and is there a BOM cost, at which you have reasonable margins and that start to become attractive. Or maybe there's also, you can change the business model. Like you don't need to be selling hardware. It can be hardware as a service. It can be a leasing model. So there's, a lot of things you can do to make the business valuable on not just selling, a one-off hardware module.
Sure. I would just add that if what you're doing does not exist, look at the next closest thing to it. And you can draw some analogy, some comparison, financial models, size of rounds, exit numbers, all of that. So it doesn't have to be exactly what you're doing, but something very similar to what you're working on. Next question. Do you utilize a framework like TRL, technology readiness level, to assess the risk level of a startup?
No, yeah.
Do we utilize TRL?
TRL,
I
yeah.
hate it.
Or any framework just to assess the risk of a company.
Go ahead, Lidiya.
I will honestly say I don't even know exactly what the levels of TRL, but no, it's obviously every time I evaluate something, I look at it from its like fundamentally, what is this company building? Have they proven out the science? Is it a lab project that's getting commercialized? Is it something that an iteration of something existing? Kind of what is the degree of change from technologies we've seen before is one thing I look at, and it's you assess the risk. We always, like, my team loves to dig deep into the product and really understand like what is unique, like what is the special sauce of this. So what is the special sauce and where is this company today? So once you look at those two, usually we get a pretty good idea of what is the associated risk with that investment.
The only time TRL becomes important, and we do that a lot, but it's only for defense and military sales, because there are regulatory requirements or legislative requirements that you can't get certain contracts unless you are a TRL 6, 7, 8, 9 type stuff. Commercial markets, you never talk about that. That actually would, if anything, indicate that you don't really understand. The important thing is commercial viability and commercial validation. Now, often people think of this as when you build a product, then you will set it up for sale, and then people will buy it, and that will show you that dog will eat the dog food. Smart entrepreneurs are able to say, here's my idea. They go to customers and they say, here's what I'm going to build. I build this mock-up of the thing, but trust me, and I can do so much. I really get your business. And they get them to do a pre-sale and use that as a validation that, hey, I have sales. Now look at this company, for example, Boom Arrow. Boom Arrow hasn't yet built a full-scale plane. It might take them a few years to build that, full-scale supersonic or whatever plane that they're going to build. But they have been raising capital for a few years now based off of, hey, we have $200 million under LOI or agreements with these. Now, if you look at the contracts, it's like, if you do this, if you do this, if you do this, like it has to be a bloody plane that works, right? It has to have the regulations and certifications and all that. But if you do all of this, I will buy. So the dog will eat the dog food as long as it is dog food. So then the investors can focus a lot more on, can they do this? Can they build an engine that works and get certified? Can they build a plane? Can they do it at this price? The diligence becomes more simple, and the belief that we will have to have in a company becomes more, restricted. Then, if you build this whole thing, will there still be there anybody that buys it? This was a problem with robotics companies like the Jibos of the world, right? Like, not to, point out, companies fail for many reasons, but they spent years and years building something. But number one, they never went out to the market in a way that people could show them that we really want this. And then, when they built it, there just wasn't customer there because there were other cheaper alternatives available. You don't want to.
I'm not sure I agree with you on that, because I think the demand was there. I think the Jibo is a different story, because the Kickstarter and they had orders and all of that. But you are right. I think there is always some element of risk, and you're trying to mitigate it. So I think the short answer is there is no kind of scientific framework.
The most important thing that the investor looks for is demand. Look at the biggest investments we talk about today. Would we have said that the biggest company that would get created on the iPad is an app to call cabs? But it is. It's one of the companies is Uber. Or photos that disappear, right? That's Snapchat, right? Food that's basically like pizza delivery, which is DoorDash. Or food delivery at home from grocery store, that's Instacart. These are now 30, 40, 50, $80 billion businesses. Yeah. And the only thing that's there that's most important than anything else is the demand. This is the problem with a lot of deep tech founders, that they get so caught up in their technology and in their product and in their IP and in the university agreements and the scientific advisory board and all that other nonsense. They forget that the only damn thing that matters is, does anybody want your product and will they pay for it?
Very true. Very true. Next question. For pre-seed funding, would you recommend angels or funds like Lux, which might be kind of willing to do pre-seed? So I think the question is, in pre-seed, should I go to angels or should I go to traditional VCs?
Well, because Lux was mentioned, I'll just quickly say it. I mean, look, these boundaries are very nebulous right now. There's no clear answer. Like, you know, it depends on who you are and how ready you are to take venture capital. You know, Desktop Metal, I was in the first round of financing, the first capital the company ever raised. Same thing for many other companies. But in the case of Robotics, Siemens was the first investor, right? Because they were incubated at Siemens and Next 47. I mean, it all depends. The important thing is that go to investors who you think will believe what you're trying to build in the long term. Obviously, if you're raising few $100,000, you know, it might be too much work to go through the venture capital hoops. But certainly these days, if you're raising, you know, $1 million, $2 million and above, everybody's playing in every category and every stage.
Yeah. So another question here. I think we answered part of it, but let's hear it anyway. A lot of robotics companies have a lot of physical products to make and prove before they can get any revenue in the company. How do you raise the capital to build out the necessary physical things good enough that companies want to pay for them? So how you move the prototypes to finished products? And obviously, this is a unique problem that you don't have in software. But obviously in hardware companies you have this.
Yeah, I mean, sometimes, yeah, I'll take that. So sometimes you have, as we mentioned, like the VCs that will take the startup risk and they will invest pre-product, and those investors exist, that they're out there, like they're willing to back you even without even a prototype sometimes. And then there's a little bit more conservative, or, you know, VCs that like to play in like the Series A or B, where at that point, like, you better have something that works, and not only that, but you better have something to show some initial demand, right? At the Series A, like, usually some initial demand, maybe not large enterprise sales, and like maybe just a handful of customers, a few successful pilots in the deep tech spaces. That's a lot of Series A's I see. But the later you are, the more capital you start adding to your stack of equity, the more proof points, the more sales you need to have, and eventually you can start. If you already have sales, then you can later in the B and C rounds. That's when you can start thinking about, you know, convertible debt or revolver loans for working capital, like SVB. There's tons of banks that will do that, but they wouldn't invest in the early stages. So that's the type of venture risk that in the initial stages, you'll need VCs to fund it.
I have to say that I mean, in MassRobotics, we speak with hundreds of startups, and I have to say that there's a gap in the funding landscape for early stage robotics companies, and this is something. I mean, it's not anyone's fault, but it do exist. I mean, there's plenty of capital for growth, but there are very few funds and kind of corporates that will focus on, I would say, pre-seed and maybe seed stage. And I think robotics kind of fall in between biotech investment and kind of the traditional software and SaaS. And I think somehow we need to develop our own approaches and methodology in terms of how do you invest in robotics companies. I mean, biotech, they raise millions of dollars before selling anything. I mean, just taking the drug into different approvals and testing, and there's pretty clear milestones for valuation and round sizes. So it's hard, but again, I think it ties back to what Bilal said, that you need to show that there is a demand, that if you give me the capital to build it, there is a verified demand out there that people will pay for it if I build it.
I would add a few things to this, because I've thought about this a lot. You know, look, and Lidiya has done as well, because, you know, clean tech had the same problem. I remember all of us walking around, oh, there's this valley of death in clean tech. Here's the problem. This is not biotech. It's not biotech because your margins are not 90%. It's not biotech because your TAMs are not hundreds of billions of dollars. It's not biotech because the acquisition comps are not at phase 3, $0 in revenue, but being bought for $5 billion, right? So it will never be biotech unless something changes in the world. It's also not software because it doesn't scale the same way. You don't have 80% gross margins or 90% gross margins. It doesn't scale globally where you can just ship the software, as you heard. Like, you know, you have to physically sell a product, usually at 50% margins. right? And the TAMs are usually very limited, right? Like it's like, oh, I have a floor mopping robot. Okay, I can do $8 billion of these in sales. At least that's how people think about this, right? So you have to figure out how you take a company through these various stages before it reaches a growth stage. I don't think that the issue is, as we've been talking about it a lot today, the issue is the idea good or bad or not? That's not the idea. But yes, what is the right capitalization for a company? If the company is at best going to be $100-200 million trade sale to some other company, there's no way you can attract a VC to put $10 million into a Series A very easily. It's going to be a hard sale no matter what, because $10 million on 25-3 already, it has to be 250 million to return to, if you raise no other capital for me to get 10x, it has to be at least a $250 million company. Suddenly
Yes.
you've capped it, right? Like, so think about it. If your business is really $100-200 million business, $500 million business, it starts to drive your strategy. And that strategy leads to who you go talk to, how much capital you raise. And there are many, many businesses that you would love to do, but it doesn't make sense as a venture business. It might not even make sense for you as a startup.
True.
Because it may require way more capital than is really needed, and you may not have that capital available.
Very true. Very true. Next question is, do VCs care about diversity in the team? I know that we spoke about that in our last call. Lidiya, do you want to comment on that?
Yeah, I mean, I wish I could, invest in more diverse teams any day, and I try to look for more of these diverse teams. We look for diversity in everything, diversity in the management team, diversity in the investor base, diversity in the full company. Do they even have engineers who are women or people of color, people who are maybe immigrants? Like, just figuring out, like, is this a diverse team as a whole? There's more and more, I would say that's a positive change, and I love seeing that. Obviously it's not enough, and there's still a lot of women in robotics initiatives. There's diverse founders. There's a lot of women in VC groups that help support. There's specific funds now that specifically have a thesis to invest to back diverse founders. So I think it's definitely a trajectory we're on. Long way to go still.
So there's societal reasons why we should have diversity, right? I mean, equality, equity, inclusion, and all of that. So I think Lidiya mentioned some of those reasons that are really important and we all care about. But I think there's another reason as well, which is look at the biotech industry you brought up. Biotech industry has a very high percentage of women participation. And it's one of those industries that, we have a lot of biotech companies in our portfolio, and they're always looking for talent, but I hear them complain about access to talent less than other industries in our portfolio. If I have a machine learning AI, robotics is all machine learning AI is a critical part of robotics many times, right? They always are complaining we don't have enough talent, right? Like, I don't have enough this, I don't have enough embedded engineers. Why? Because in a lot of these industries, half the population is sitting outside. They're not included. I mean, obviously it's not because it is structural reasons or whatever the reasons might be. If we had more participation, it would actually make it more easy to have great engineers, great designers, great executives on the team. And the thing that I keep hearing again and again and again, and I don't know how to tell CEOs and founders this, a lot of founders tend to believe that, when you grow large enough, then you have to care about diversity. The problem is that it is, number one, very hard at that point. But more importantly, if you have in your early team, early executives or a co-founder or two or whatever, or early employees have women, it attracts other women, right? It's like it becomes easier for you. You don't have to do anything. You don't have to have a diversity initiative because it automatically is a diverse team.
Already emotional.
Hire an HR person to, how do we make sure that, no, because it already is. And I think, the problem that happens is that those of us who've been in venture long enough, we can see that, hey man, you're gonna be, it's like you will need 2 bathrooms. Get 2 bathrooms. One doesn't work, right? And this is one of those things that the CEOs in the beginning are like, no, let's just go with 1. I'm like, dude, like literally 2 years later, you'll be coming in, I don't have space for the 2nd bathroom. It's like that. Like, these are simple things that should be so obvious that we shouldn't have to do this as a diversity initiative in any way. It should be just common sense that these are the best talent, go out and recruit people. Like, if we did a better job of recruiting talent from other industries like biotech and others, we would have amazing talent available to our companies.
Very true. Very true. Next question is about thoughts for great milestones targets for seed and Series A for robotic startups. So I think we spoke about the different kind of stages. What are the kind of clear milestones that founders should keep in mind when they are fundraising for seed or Series A?
So I'll give you for seed, and then maybe Lidiya can talk about the A. In the seed stage, I always say your seed should have one or two questions that are existential. That should this company actually exist?
Yeah.
You should be answering those questions. Usually, unless you're doing something that's very science oriented, like there's a scientific risk, usually it comes down to two things. Number one, can you build a team? And hence you have a great team that you can go into Series A that you know it's working. And number two, do you have customer validation? Right? Yeah. Remember what I did not say. The product, the sales from the product, scale, manufacturing partner, those things can come later. The important thing is that do you have a team that can execute on a, meaning they're ready to get going. They're ready to get accelerated. When you pour the fuel on the fire, they're ready to go. And the second is, they can only go if there's like a pull on the other side that I want this. If those two things, I mean, again, some startups may be different, but generally those are the two things that I find at the seed stage really important.
Interesting. Lidiya?
Yeah. At the A, at the A, I want to see usually technical risks to be almost de-risked. Like maybe you're on a trajectory to, obviously you're always on a trajectory to improve your technology, but I want to see that at its MVP, at its core, the tech works. And I'm investing in something that works with initial sales. And initial sales can mean many different things, especially in deep tech. That could be a few pilots that are very successful. I want to see actual arm's length transactions. So like if you're selling, to SpaceX works with every, they love working with startups. They run like a startup themselves, and so many startups I talk to like have some deal with them, which is great. And if you're in aerospace, like they're a great first customer, but I usually want to make sure like, can you really execute on a sale and can you escape pilot purgatory? So that's what I've seen with a lot of robotics. Companies get stuck in the pilot purgatory. A lot of big corporations, Bosch, Siemens, like OEMs, tier one OEMs as well. Like they're, everyone loves a pilot. It's easy. Usually, some of them will have companies will have an innovations department, or they'll run something with you. But escaping that and getting from the pilot to your first real commercial sale and having your parts being used in production, that's the big challenge, and that's usually what I'd love to see at DA. Sometimes it's tough to get to all of that traction, but the more you can show early on, the better it is.
Sure. Next question is about dual purpose companies. So what advice do you have for robotics companies with dual purpose, so government and commercial technology, to scale the company with early funding from the government, kind of R&D funding as a means to commercialization? I think we commented on that a little bit early on, but I don't know if you have anything to add. Bilal, do you want to? I know that you have.
Take it. I mean, look, a lot of companies. Yeah, a lot of companies choose to become a dual use company because defense can be early partner, early customer, early NRE grants and stuff. But it's really important to then be in your mind very clear that are you becoming a defense contractor, or are you a dual use, but you're a commercial company that also happens to sell to defense. It is where people get confused is that, remember, defense by and large, with very few exceptions, and especially in the hardware sector, they will make sure you have to do something that really only works for them and is not useful to anybody else. So it is very easy for an early stage startup that starts to do defense work to start to incorporate, if nothing else, cultural behavior that is good for defense, but it would actually hurt you and slow you down on the commercial side. Right? You want more open source systems. You want to utilize all the software that's out there. Well, defense doesn't always necessarily like that. Sometimes they do, but sometimes they don't. They want, you on a certain schedule of payments. They will give you more NRE than contract money. Well, you want customers on the commercial side. They don't give you NRE. So, what muscles you exercise becomes really important. It's a little bit like thinking about it as, you know, there are only a few players in the world, some are, who are good at basketball and baseball, right? Because what you need to do to train for one versus the other is not always the same. Now, the right way to do this usually is to say, I'm going to hire a generalized set of experts, and then I'm going to have specialists who are dedicated to different fields, right? So my technology development team may be common, but then I have, and in our portfolio, well, you see a lot of companies do this. They create subsidiaries that are defense only, and within that, they will have a certain, you know, culture. I mean, like, you know, business culture, like, you know, how do you contract, how do you work, and so on. And the commercial team stays separate.
And also, just wanted to quickly add, for example, you need to early on set up your company in a way to be able to work with defense, whether it's, you know, a separate entity, whatever it is, but ITAR certification, just making sure that you go through compliance. It's not something you can backwards then edit, like, oh, now I all of a sudden have compliance. You need to build that compliance from day one if you want to work with defense, because it's very restrictive on all the requirements that they expect from you.
So quick question about company and corporation. Do investors really kind of care about formation in Delaware? Is this still something important? Do investors shy away from companies formed in MA in Massachusetts? Any take on that?
A simple take is, you know, there's too many other problems in a startup to add more problems to your list. You know, without going into the every nitty-gritty legal detail, there's a reason why 95+% of the startups that you will work with are Delaware corporations. It has a whole bunch of reasons. It has corporate governance reasons, disclosure reasons, all kinds of stuff. You know, you can incorporate your company in Timbuktu if you want it, but then deal with it. I just invested in a company in Singapore. It took 2 months to close the deal because of all the stuff that needed to get done. And, you know, we probably spent, you know, I don't know, maybe a quarter of the money we raised on just lawyers trying to do this. Like, it's not worth it.
Interesting. There are two approaches for piloting advanced automation solution to the market. Delivered to the client and expensive AI-enabled robotic system with some level of context awareness, and not that kind of high quality system, kind of an MVP. Such a system needs constant support and updating of the AI component. It's really a long question.
I think we got it.
So,
yeah.
Testing of the system perform well in different scenario, and only after that milestone going to add AI agent based or verified input data. Which works for you as an investor and why?
No, it's a good question. I think I got where you're going with this. So it's about shipping something to the customer that's not fully baked, right? And as a startup, you kind of have to do that. And as we discussed with Debo, like, you know, they wanted to ship something that's fully, you know, took several years to build, and then just that wasn't the right product market fit or whatever the story was there. But if you take too long to make your product perfect, you're too late, right? So the whole idea of lean startup, like innovating, iterating, you have to ship something. First of all, you have to find your early backers and your early customers, which will be with you for that ride and for that customer discovery. And that might mean maybe you get some NRE, non-recurring revenue from them, to develop, you know, the product with the needs of the customers. That sometimes, you know, it could be also a double-edged sword, because then you're developing the product for that specific customer if you have just one of them, and it might be too specific for that customer. So make sure as you do that, as you sign these early agreements, some of these customers might want exclusivity, which you might not want to give, or you might limit it like very, very specifically to one application, one geography. So be very careful with exclusivity agreements. VCs don't like seeing these, and just, you know, make sure you find the customers who are ready to be with you for that early ride.
Interesting. One last question. We're running out of time. It's actually from Latin America. So, so this is a company that they're raising their seed round. They have a proven product already deployed with 15 clients. Their problem is American VCs are not interested in Latin American companies, and Latin American VCs are not interested in deep tech companies. So any suggestions here?
Maybe I can go first. I mean, look, this is a real problem, not just Latin America, but around the world. Most places in the world have less developed investor ecosystems, especially for deep tech, and there are many reasons for that. One of the things I'll say is, number one, COVID. One of the things that it has done, it has flattened the ground, right? Like, I used to go to Boston maybe once a month or more often sometimes. Because I felt like I had to see the companies there and had to go visit my portfolio. I haven't been there in over a year, and things are still happening, right? In fact, 2 of them went public during this time without me having to ever be at their office. So if I can do that in Boston, I can do that for a company in Estonia. The problem that you run into, and this is what I think you have to understand about the US VCs. I can't tell you why there's no VC in Latin America, but the thing is, we are considered, the reason Lidiya and I get paid is to be value add VCs. We don't just buy a lottery ticket and then sit back and see what happens. Our job is to help with strategy. Our job is to help you get customers. Our job is to help you build an executive team, is to do governance. When you're outside the US, a lot of those things start to become very difficult, unless you were sitting in Estonia, but really everything else was in the US. All your customers were American, you were hiring your business teams here. If you ask me for, I'm looking for a VP engineering, I know either a lot of VP engineers I can recommend to you, I know exactly the right search firms I can recommend to you to find those. But if you were telling me that I'm in, Norway and I need a VP engineer,
yeah,
I can only guess, right? So I become less useful as a partner.
sure.
And which is why I think you find in the early stages, when we invest abroad, and I can only speak for myself now, Lidiya may have a different perspective given that her fund is European, at least the company is European. We do a lot of investment in Europe and Asia and other places, but it's almost always with also a local partner. Like, there are things I bring to the table that are very relevant and useful, but I need somebody on the ground. Like, I cannot be helping them figure out if you should set up offices in a major city or in the suburbs, or somebody needs to be there to help those kinds of things.
Yeah. Lidiya, do you have any final thoughts?
Yeah, on the international investment, to Bilal's point, I would just add that to invest in another geography, you need to also understand the market dynamics in that geography. When you see different, companies on the cap table, or just names on the cap table, you don't know if those are those the best funds in that industry? Are they just random funds that were just created? Like, there's a lot more diligence you need to do,
Sure.
a lot more homework to understand market dynamics, to understand the path of this technology, or how big is the market in another geography. So usually, for example, for us, we've restricted it to 3 main areas. That's still a big part of the world, but we have local, as Bilal said, our local experts who know the ecosystem, who are in touch, they're in the flow of who are the good companies, who are the good investors, working together with them, and that's just the model that's worked for us so far.
Amazing. I mean, one other solution is to come to the US, have an office in MassRobotics, and then we will open up all of our network to you. Thank you both. Unfortunately, we ran out of time, but this has been amazing. I mean, time just kind of flew by. I do think that we need to have a part 2 for this discussion. So we will be in touch to kind of plan that. But Bilal, Lidiya, thank you very much. This was very insightful. There is a bunch of questions that we didn't get the chance to get to. If you are still on the call and you didn't hear your question being answered, I do apologize for that. Every question is important, but unfortunately we ran out of time. Thank you both. Thank you for all the attendees. I hope this was up to your expectation. And again, this event is recorded and it will be on our YouTube channel, and anyone who signed up for the event will get a recording. Yeah, just stay in touch and let us know if we can help in any way in your venture journey. Thank you both.
Thank you.
Awesome. Thanks a lot.
Take care. Bye, guys.
Bye.
Bye-bye.